You're listening to Real Investor Radio with Fuhr and Jack BeVier, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. Well, hey, welcome back to the Real Investor Radio podcast. I'm Fuhr, joined again by Jack BeVier. We've got a whole lot of things to talk about today. And if you're just joining us for the first time, we are a podcast that's focused towards advanced investors. I'd encourage everybody to go back and take a listen to or look at all of the 70 plus episodes that we have up so far. Jack, we got a lot of guests coming up in the coming weeks, but today we're just going to go sort of round robin through a whole bunch of topics that have tickled our fancy. Yesterday, by the way, how are you doing today?
I'm good, buddy. I'm good. Good to see you.
Yesterday, you spoke at the Maryland Investor Network. As many people know, where Dominion is located here in Baltimore, Maryland. We've been here since 2003. And so obviously we know a lot of local investors in the DMV area. And so yesterday, Jack, you spoke at the Maryland Investor Network hosted by our friend Brenton Hess. What was the topic? I heard it was very well attended. So I heard it was like standing room only. So good for Brenton.
Yeah.
Sounds like a hell of a crowd.
Yeah, Brenton's put together a great group. There's lots of real estate investor Facebook groups, and the Maryland Investor Network, which was originally started by Mark Owens.
Yes.
Kind of passed the torch to Brenton Hess, is doing really a phenomenal job of building it up and building that community and bringing content to all the members of that group. I think it's one of the best run real estate investor Facebook groups in the country.
I like how he's straddling the line, Jack, between sort of like online Facebook group and in-person sort of meetup real estate investment club. And there's over 25,000 members in the Facebook group. I don't know if they're all local, but yesterday I think he had over 200 people in the room for the monthly or sort of I guess it's maybe a quarterly meeting that's open to everyone with vendor and a whole bunch of real estate investors in the room. So yeah, go ahead.
Yeah, exactly. I think he's got about 100 vendors that help support the group. So they've been able to really invest. They have a full-time person, Kelsey Bollock, who does a phenomenal job of keeping everyone organized and making sure the content's moderated appropriately and that there's high-value content on that page. So I think they're really kind of an example of like how to do it right. Like you said, they put together this in-person event, and it was 3 different panelists that Brenton interviewed. Aaron Alberti, who is just like the best contractor in Maryland for real estate investors.
Yeah, we've often said if Aaron dies, like half the investors in Maryland won't have anybody to do their projects for them. So yeah, Aaron's definitely got his shit together.
He does like 400 rehabs a year, 50 to 100 for himself. He's got literally like hundreds of guys that he has on staff, and they do a great product, and they've been really instrumental in a lot of wholesalers turning into flippers, right?
So you and Fred do a lot of projects. I mean, you guys are still buying 100 houses a year. How many projects do you think you'll put into rental or flip this year?
We will?
Yeah. Or let's say, how many did you do in 24?
Yeah, sure. I think we did 80 in 24, added maybe 35 rentals, probably flipped 40 and wholesaled the rest.
Can you imagine managing the staff that Alberti has?
Yeah, it's extremely impressive.
It's unheard of. I mean, it's
incredible.
It's like the greatest babysitting exercise of all time.
Yeah, he does a great job. So it was Brenton interviewed him. He was first, and then Neil Roseman, who owns Block M Investments, which is a hard money lender in Baltimore. He also owns Lead Probe, which is a lead paint inspection company, because we have compliance here in Maryland around that issue. And then Lodestar is his home inspection company. Super smart guy. I've known Neil for like 15 years, so we're good. So his content was excellent as well. And then Brenton interviewed me about, state of the market, what we think is going to go on, talk about the businesses a little bit, building the companies, how we got there. So it was, kind of a 20-minute interview, but we got lots of positive feedback from the room that the content was good. So that's what Brenton was going for.
Well, let's dive into the state of the market. We talk to investors every day here at Dominion Financial. And, I think the sentiment that I hear, Jack, sort of the underlying tone is a tone of optimism. Hey, we're just plowing forward. And, we've talked about this many times on the podcast where it's a time for guys who have been in the market for a while to really tighten operations, really understand their KPIs. We talked to Frank Cava last week on the podcast about like sort of all of his marketing and the KPIs that he monitors just to make sure that his marketing dollars are well spent. I think it's that time, Jack. It's that time where if you're an investor who's doing 5 projects a year and you want to get to 10, you better tighten your operations and you better figure out where your equity and your debt is, because I think those 2 factors are going to be a major factor. Where are you borrowing your money to scale the business in 25? If you're a guy who's doing 20 and you want to get to 40, those data points that you have to monitor constantly, I think only become even more apparent. So what were your feelings on that and everything else you talked about yesterday, state of the market wise?
Yeah. So as we sit here right now in mid-February, I think that this was Aaron kind of kicked off with this sentiment, and I agreed with it, that I think the past 90 days have been some of the most difficult in a very long time. Like we've had 15 years of up market, right? And after the interest rates increased in October, that was kind of the bottom, and then interest rates started to go up again. And now here we sit with, 7% mortgage rates to homeowners. Showing activity really decreased. We're starting to see price drops on a regular basis, but the market's just thin. So it's like, I feel like the consumer sentiment right now is like, it's a bad time to sell and it's also a bad time to buy. And like the market's just kind of frozen up.
So Brian Leibowitz on a call that we had company-wide mentioned that I think you guys sold 4 houses around in the December, January timeframe, didn't you?
We got a little pop right at the beginning of the new year, but it was like, it was almost like, it was a New Year's pop, right? Like
Blip on the radar.
Hey, we got to get out there and let's go buy a house this year because we need to. And then after that week was over, things, quieted back out. And I think it's largely driven by rates and also a little bit of uncertainty because there's a lot of things changing in the world right now. So just consumer sentiment right now is not aggressive. We're also, pre-spring, of course, but it's been a tough 90 days from a showings perspective. And then rates are higher right now. So it's not like there's a, super economical bailout on the refi side of things. Banks have continued to stay really out of the picture. They're just further withdrawing. And
for investors, you mean?
Yeah. And so I think it's made it tough from a liquidity perspective for real estate investors. The past quarter has been a tough cash flow quarter. And I'm nervous that there's no reason that it's going to improve. Like I can't quite put my finger on like that this is going to get better in the short term. I think that, I'm kind of hunkered down for the medium term right now.
What does that mean?
Super bullish. I'm still super bullish on, American real estate long term. So like I'm adding as many rentals as we can afford to from a cash flow perspective, but wholesaling and flipping has gotten harder. And so that, as many as we can afford to just got a lot harder. And we haven't seen a big increase in inventory. So I feel like, cash flow is the thing that breaks you, right? Like, when you just run out of cash, it's not like, that's when your behavior changes because you just literally can't, show up to the steps or can't, put that next house under contract because you got to get these 2 albatrosses out from off your neck. And I feel like we're coming into that time right now where we may actually see some tide shifts in terms of distress kind of come through the market. So
distress from a homeowner standpoint or distress from maybe some real estate investors who are stretched thin standpoint?
Yeah, real estate. Right now I'm talking about real estate investors that are stretched thin, but
too many projects on the plate, can't get rid of the ones you got, not really getting much cash flow off of some new rentals that you put into the portfolio.
Yeah, exactly. And all those things, right? Like there's like kind of nowhere to hide,
Yeah.
And then kind of on the back of that, I'm concerned, we happen to be in Maryland, and I'm concerned about, if Trump is successful and they are just, they're guns blazing right now, right?
It's Christmas Day every day if you're a fan.
Yeah. From a philosophical perspective, huge fan. As somebody who lives in the DC metro area, however, and wants to put out a product that those federal employees have been big buyers of forever, right? Especially over the past 30 years. I'm nervous about that, right? Like if all of a sudden we axe the Department of Education, Transportation, and cut HUD in half, those people live in PG County and Montgomery County and Northern Virginia and
Baltimore.
In Baltimore. So I'm concerned about a regional recession in the wake of cost cutting, right? In the wake of austerity.
So there's currently 2 million people who work directly for the federal government, me and the Baltimore Metro, DC, Northern Virginia area, and obviously elsewhere in the country. And then another 2 to 3 million or more who are contractors in the area, that work as contractors. And so I don't think it's an insignificant worry. I think that if he gets the downsizing of government that he's seeking, I think there's going to be a lot of people that are left with a pretty decent severance. However, what do you do when that runs out? And so I think, do you see, and I believe that has to happen within 2 years. I don't know that he's got a 4-year runway on that, right? And so a lot of disruption. We talked about this earlier in the year, a lot of broken glass to get to that point, which I think is better for the country, frankly, if there's just less government spending and less overhead. But it is definitely not an insignificant. It's not an insignificant thing if you're an investor in the area. I think you have a very legitimate concern there.
Yeah, and I think that, and what won't happen is the Fed decreasing rates as a result, right? Like that's a regional recession. The overall, country's economy can be booming, and one would expect that with a Trump tax cut, package coming up in the spring, that the stock market's going to look very favorably upon that. And so the stock market could be doing great. The national, unemployment rate could be very low. And yet we're stuck here in a regional recession. And rates stay where they're at, even though everyone's sucking wind here locally. And that would be a recipe for price decreases.
Absolutely. And maybe a lot more inventory coming on the market with people losing their homes and things like that.
Yeah, well, losing their homes but also like for landlords, their tenants lose their jobs. That'll exacerbate the headwinds that they already have. So that's kind of like my I think that's a real possibility.
Let me ask you this. I know that you and Fred with Dominion Properties, most of the rentals that you have are subsidized Section 8, correct?
We do a lot of that, yeah.
And I know that you keep very close ties with the local housing authority. What's your take on how the new administration might affect that and either increase the budget for subsidized housing or decrease it?
Yeah, sure. So Scott Turner's going to be the new HUD secretary, and he's gotten headlines for his desire to privatize the agencies, Fannie and Freddie. I don't have a clear line of sight on what his perspective is in terms of the HUD budget. Past Republican administrations have looked favorably upon the housing choice voucher program. Because Section 8's an umbrella, right? There's lots of stuff inside of Section 8. There's public housing, there's project-based vouchers, there's LIHTC, and there's housing choice vouchers. Mm-hmm. Housing choice vouchers are kind of the most Republican of the housing subsidy programs.
So it gives people kind of the freedom to choose where they want to go.
Yeah, exactly. And works with private landlords as opposed to giving money to another government agency to administer stuff, right?
Sure.
So past Republican administrations have been good for the housing choice voucher program. They've sometimes have gotten a relatively increasing percentage of that budget as they've moved away from public housing. But I'm not sure that I don't have direct line of sight on what budget modifications or reallocations we might expect under a Scott Turner HUD. I think that's TBD for me.
So I was taking a look at some headlines prior to coming in today, and the National Association of Realtors is expecting the mortgage rate in 2025 for homeowners to be around 6. Maybe come mid-year into the 6s and maybe get to 6%. You're smiling because I don't know that you feel that same sentiment.
Yeah, I don't. And the National Association of Realtors always is projecting that mortgage rates are going to come down, right?
Yeah, right.
Because they're trying, because it's good for business. They're talking their book, right? Like
Right.
I think they always project a decrease, or at least they're like on the low end of all of the conservative or low end of the estimates. Whenever when you put together the Mortgage Bankers Association, National Association of Realtors, all the other trade groups, and what they think that where mortgage rates are going to be, NAR is always at the bottom.
Any other insights from yesterday from the Maryland Investor Network?
Yeah, so and so I mentioned this, I think we're having current headwinds from a cash flow perspective as an industry. I'm concerned about a regional recession that won't get any help from a monetary policy perspective, so we'll just be eating it. And then I'm concerned from a 2026, 2027 perspective about an actual consumer recession because of AI's impact on $50,000 to $80,000 white collar labor. Frankly, I think it's coming faster than we're going to be able to adjust for from a political perspective. And the fear of losing your job, the fear of having your job being replaced by new technology and having to repurpose is going to I think it's going to disturb the labor market. And this one's going to be a white collar recession. It's not going to be a blue collar recession like we had last time. And so that I could see that as a real possibility next year, 2020, 2026, 2027, that stuff really flowing through the economy. So I'm hunkered down right now. Like mentally, I'm hunkered down. I'm like, only do the things that we're great at. No new shiny objects right now. Focus on cash flow and not planning on setting any records in the next couple of years, because I think that it would be imprudent to go out on a limb right now with so much risk. That I perceive in the world.
How do you feel about, we've mentioned it a couple times on the show, Dominion Properties is currently building some multifamily here in the Baltimore metro area. How do you feel about multifamily in the area as well as sort of elsewhere in the country? We saw it kind of drop, some significant price decreases around the country in multifamily over the last year. How do you feel about this year, especially with all the units that you guys have coming online?
Yeah. I mean, Maryland has we don't give out permits in Maryland, like they do in other states. So there's a very little new construction on a relative basis to other parts of the country. So we don't have the new supply issues that other parts of the country have had to deal with.
We do have a fairly significant amount of top end supply though, don't we, Jack? Like stuff that's kind of maybe sitting a little vacant right now that of not necessarily affordable multifamily, but sort of top end multifamily. There was a I'm thinking Baltimore Peninsula.
Yeah, there was a chunk of deliveries in that segment, but it's not like there's cranes been up for the past year or two. There's not new stuff that's coming on, especially not when you compare it to other parts of the country, like west coast of Florida,
sure,
like coastal Florida, big chunks of Texas. They've got actually give out permits and people actually are building there. And as a result, you really see cyclicality within the rental market as well. Whereas because we have on a relative basis, not that much new inventory as a percentage of total housing supply, new housing supply doesn't tend to move rents that much. You could, oversaturate a particular spot, but mess up that market there. But as an MSA, it doesn't really move the needle. But the multifamily brokers that I've been talking to, they keep telling me that hey, we're just seeing banks and the insurance companies that own the debt on these multifamily projects just blending and extending, right? Just kicking it to the back, kicking the back, taking whatever cash flow is there, but not wanting to foreclose. But and then the question is, can they just do that indefinitely or not, right? Who can do that indefinitely? Because I don't think anything we just described leads to a lot of strength in rent increases on a going forward basis. So I think that it'll be tough to continue to increase rents from the landlord's perspective if we're walking into a weaker consumer environment. And so we're not going to be able to just pass it through. And if that's the case, then can do the banks and the insurance companies and other debt holders of the multifamily debt eventually just say, at some point say, hey, you know what, we've been, we did this for 3 years, but we can't keep doing it. It's, we think we're above water enough. Let's pull the ripcord here. And so, yeah, because we really just haven't seen this influx of multifamily supply, even though there was some, poor lending practices happening back in 21, 22. And that hasn't come, this hasn't come home to roost yet. So I think that's another thing that we're keeping an eye on. It may be a source of opportunity. but you're going to have cash to do that, right? And that's like, that ends up being the tough part, right? Like everyone thinks about the cash they have now when they're talking about the opportunity that's going to come a year from now. But there's this cognitive dissonance that we do as people, as humans, that we like don't project that, hey, if everything else is getting worse, why would I be an exception to that, right? So like, you're like, hey, I've got cash now. I feel good. I could take advantage of opportunities if they happened right now. But the opportunities don't come out in the healthy environment where you've got cash. The whole economy squeezes you until you start to break, and then they present opportunities. So, the people who were like talking to, people who were talking a year ago about gearing up for multifamily acquisitions won't be in the cash position when the opportunities come out. That's why the opportunities came out at those better prices. And so it's really hard. It's really hard to survive to be in a position to take advantage of those opportunities. Like everyone knows that's what you're supposed to do, but but being in that position is much easier said than done.
I have such a hard time, Jack, remembering what I had for breakfast yesterday, much less the names of the folks that we've had on the show. Who was the gentleman from Zelman that we had on?
Tony McGill.
Yeah. So Tony McGill. And I think we had a couple other guests that were saying that there's probably not a lack of equity right now sitting on the sidelines. And I don't think that lenders like Dominion are going to, nobody's folding up shop. I mean, we've still got, capital at our backs to fund deals. So I've said this on my LinkedIn page several times, and we've said it on the show that like getting back to the whole idea of better operators when those opportunities come along. I think those are the guys that should be developing the relationships right now, proving what their experience and sort of, their operation to the equity side of the equation. I think, do you feel me there?
I'm with you.
Let's say we'll just take you, for instance, right? Like, 20 years in the business, just an unbelievable operation, very tight from management to tenant operations to, construction, all of that. I can't imagine that if you needed some equity, it would be difficult for you to go out and find those relationships, to establish those relationships, so that when the real opportunities came along, the blood in the streets, as they say, you would be well positioned to take advantage of those opportunities. Yes or no?
Yeah, I think, track record matters then. Absolutely.
And do you believe that there's a tremendous amount of equity on the sidelines for those types of, bigger opportunities that might be coming along?
If and when pricing came down, right? Like if pricing comes down to the point where the return profile of getting in becomes sexy, like it's not sexy right now, right? Like you're buying multifamily at a 7.5 cap, like 7.5 cap, like you get, you can publish a levered 10, like it's not sexy yet. When you can publish a levered 18, then equity will be interested, but we're not there from a pricing perspective yet.
Yeah. So over the weekend, I think you were in Houston meeting with the Real Investor Roundtable, which we've mentioned several times on the show. Maybe you can discuss sort of the caliber of individuals who were in the room, maybe talk about some of the guys who are in the room. And these are all, top investors from around the country. And then tell us what some of the takeaways were there.
Yeah, I freaking love this group, man. Every time I go, I'm like, God, like I gotta, figure out how to like work this into the schedule. And
it's
then
always that way. Then it's like going to the gym and you get there and you're like, I'm kind of glad I'm here.
Yeah,
right?
Exactly. And then afterwards, I feel really good about myself, and I always have actionable stuff to come back and implement into my company, right? Yeah, like you said, it's about 25 operators from around the country. We get together. There's probably like 40 people, guys and girls. There's some excellent women as well, of course, and get together in person for 2 days every 4 months, and just talk about what's going on, what's working, what's not working, most importantly, what's not working, and get perspective from everybody on those, because other people in the room have experienced the same challenges. So It's and everyone's got different talents, right? And works on slightly different things. And so, just because it worked for them doesn't mean it's going to work for you, but the perspective is definitely relevant.
It's a wide swath of guys that are operating in different asset classes, not just single family.
Yeah, and have different sized operations and are on different platforms. So, and for all for good reasons, right? Like that there's lots of ways to approach this business. And so giving those different perspectives and different geographies and from different, talent levels, or not levels, but different personality styles is really, really informative. And we always bring a ton back to our business. I would say, like, from a general sentiment perspective, there was like some similarity to what I was just talking about in terms of like concern. Like 2024 wasn't anyone's best year. Guys made money, guys, finished their pivots from executing. A lot of guys were pivoting, in the wake of 2022. You had to like change up. You couldn't just keep doing things the way you were before. And so a lot of guys finished that operational pivot in 2024. There was a lot of investing in infrastructure that happened and investing in people that happened in 2024.
Yeah.
And deals are still hard to find. Then we capped off the year with like, a slow quarter as interest rates climbed back up. So no one was like, hey, we're 10x and, we're 10x in our real estate business this year.
Right.
But there's a lot of folks who have built diversified businesses. It's really funny, actually. Like pretty much everyone Joey Bashir's from Alabama pointed out that like, dude, everyone in this room, like 5 years ago, there was a lot of just wholesalers, just flippers, just rental guys, just lenders.
Right.
And now like the entire room is doing three things because you need those three pillars to like even yourselves out and like from a cash flow and a profitability perspective.
Yeah.
And it's like that idea has become really like, I feel like pretty much a best practice at this point where you need some active services income where you're the best at something where you make money doing that and you invest in real estate. And, so you have to have the skill sets necessary to find deals and renovate properties and property management if you have to, or if you want to, but balancing out, but committing to being just doing one thing is, a good place to start, but it doesn't give you long-term stability. And so pretty much everyone in the room has done that, a version of that. And it just kind of emerged organically. Like it was never a conversation. It just, but you see everybody
it was purely
just
out of
that.
necessity.
Yeah.
Right.
Yeah, exactly. So yeah, it was a really,
I don't
really
know that
it's
conference. Something, I don't know that that pivot into, other facets of the business would be well advised for someone who's just starting out to intermediate. I mean, you're as a starting out investor, you're already wearing every hat in the business: marketing, contracting, deal flow, acquisition and disposition. So it's a lot. I was speaking to an investor the other day, as a loan officer with the company, and the guy quit a great job, made a lot of money, quit a job, and I think he's generally a smart guy. But they're trying to build a rental portfolio. And I said to him, all due respect, how are you paying the bills? How are you paying your mortgage? How are you sending your kids to school? How are you paying for groceries? And he was like, we're really trying not to take any of the cash flow out of the business. And I was like, are you guys going to flip any houses? He says, no, we're keeping everything. And I was like, where do the paydays come from? Like, where are the chunky paydays you need to pay your bills? And he was like, I've been doing some snow plowing and, do a little landscaping business on it. I'm like, I like the hustle. I really do. But like, that just takes away from what I think you're trying to do from a real estate investor aspect, right? Like, I don't know how you know what I mean?
Yeah. And I get nervous about that storyline.
Yeah.
Because they're getting cash flow paydays, right? Like you have to, right? But then the answer is that, you're getting it from debt. Like you're getting it from the refi. And so you're levering every property to the hilt to make cash flow work because you're not making it anywhere else. And so that perspective or that approach can find you like just totally levered. And if you don't understand your expense ratio well enough, don't know just because you're new to it, right? Even like you could find yourself with an over levered portfolio that doesn't cash flow, and then you're chasing the next deal And that's literally, it's your own version of a pyramid scheme where you're just like feeding the exodus of cash with new deals that eventually that does blow up. But we haven't seen that happen. We haven't seen that really play out. There has not been like a guy's got 50 properties that he built with a DSCR, 50 property portfolio that he built with DSCR, and that comes to foreclosure. That hasn't happened yet. I'm looking for it, but I'm not seeing it.
The foreclosure rate in DSCR is still historically low, is it not?
Yeah, the delinquencies started to pick up in the fourth quarter last year, but all non-QM products did, and DSCR did less than everything else, and still like kind of well within acceptable guidelines. So it's definitely there's a company called DV01 that does phenomenal research on remittance reports of securitizations, which is basically like what the securitization trustees have to publish. Like they have to publish the data of how things are going. And so they aggregate all that data across all the different securitization shelves and show, so you can get a sense of like a broad swath of performance data across an entire like loan product. And so they do that for all non-QM, and including, so DSCR is a specific thing that you can pull out of their data. And I've been watching that. And so there's been a little bit of an uptick, but it hasn't been crazy, and it's been less than everything else. So there's still tremendous demand from loan purchasers to buy DSCR loans.
Let's get back to this. I want to come back to the state of DSCR, but going back to your RIR meeting in Houston, you said, it's always a labor of love to get there, and then you always come back with something actionable and some excitement about something. What are you excited about? Well, like from that room, what did you come back, kind of wind at your back? Like, I'm excited.
Yeah. I mean, we're working on some AI projects that I'm excited about. Just automations and getting rid of like people scrolling through PDFs and getting rid of people clicking around in a software, just stuff that like where they have to do
crazy repetitive, right?
Yeah, all that stuff is like totally doable right now with existing technology.
Mm-hmm.
Your data has to be set up, or your database has to be set up in a structured way such that you can, program that stuff into the system. And that's a lot easier said than done for a lot of folks. But I think we're starting to see efficiencies in production now, like literally now. And that's not common like that. There are a couple in that room. There were maybe 4 companies that were actually trying to do anything with AI in their businesses. And by the way, this is like, in my opinion, one of the most sophisticated rooms in the country, right?
I agree.
So like, there's 25 companies in the room, and 4 of them are actively working on this. Only 2 of those 4 actually had anything in production, myself not included. We do now as of this week. But so like, I feel like we're trying to balance the idea of like, is it important to be an early adopter here? Can you wait and just let the private market produce the product and then bolt it onto your existing system? It doesn't make sense to spend the money to be an early adopter. That's like an active debate in that room.
What was the consensus?
There was no consensus. It was an active debate. Some people think I'm an idiot. Other people think like, no, dude, I see the vision. Like, do it. Like, I can't wait to hear about the next one. So,
don't you think, Jack, as an early? I think what I hear you saying is, do we wait for the private market to come up with the solutions that more than likely they probably will? Or do we start to develop those solutions now, knowing that there might be a better solution coming, but at least we're familiar with the process, sort of like how to bring something from an idea to fruition, so that when advanced AI, agentic AI comes out, we're that much further ahead of the game.
Yes, exactly. Like that's kind of the debate right there.
I have to honestly, like, I don't know how much capital you're spending on that right now, but I'm on the Jack BeVier side on that. I think if you don't have people within the platform who are well versed in how to take an idea and turn that into something that is workable through AI, you'll never be the early adopter of the private product that might come out 6 months from now.
Yeah. So like, I'll steel man both sides real quick, right? So the wait and see perspective is, I don't know shit about engineering. I don't know shit about data science. Like, but you're going to tell me but I should go hire some nerds that are going to come into my system, which is in like 4 different pieces right now, and like link it all together so that I can create a chatbot. Like, I'm cool, like that's not going to help me buy more houses, dude.
Right.
Like, that's just not going to help me buy more houses. And my issues are buying more houses and getting construction work done cheaply and making sure that my tenants are paying the rent on time. And I think there's like probably some easy arguments. Everyone's like, hey, there's probably some easy applications for this in property management, but Propertyware or Appfolio or Yardi are going to come out with their own version that bolts right on top of the software that I'm already using and allow me to be more efficient and not have people clicking around, because they'll have some agent built into their system that clicks around. They're going to productize that for me. Why the hell would I go build what they're definitely building? And they're the nerds already. Like why would I build it on my balance sheet? I'll like just rent it from them after they build it on theirs. And I get that perspective. I totally understand. Like, I think that's very logical. I can absolutely see that they're like, very, intelligent, reasonable points in that. I think the other side of that coin is that this is like the internet, but probably much faster. And we're all going to have to learn anyway. So you might as well roll your sleeves up and get comfortable with the concepts and the ideas lest you just get overrun by a workforce that learns around you and frankly just like eats your lunch, right? So like, I think that I'm concerned that, or rather my perspective is that it's something that everyone is going to know how to do in 5 years. It just decide when you want to go up that learning curve. And I'd rather start to implement things into my system early so that I can migrate my team skills, their job descriptions, up to the things that are fundamentally human that AI cannot do. Because if I wait for other companies to do it themselves and lower their cost structures, I will be losing ground from a competitive perspective as these other companies around me who are making these investments become more efficient machines and deliver a better service level to their customers. And then all of a sudden, the private market will come in and say, hey, I've got that solution for you so that you can keep up. And then I'll have to bolt it on and lay off 20% of my people. And I think that, frankly, that would be a very unethical thing to do, for just to sit back and wait for technology to force me to axe a bunch of people, right?
Sure.
Who then are then completely unprepared to do whatever else because they haven't been familiarizing themselves with these concepts, are not comfortable with these ideas. So I think that there's like a little bit of an ethical perspective to leaning into this, but I'm also doing it purely from a self-interest perspective, in that I think that we can get productivity wins along the way that have a self-evident return on the investment that we need to make. It's not like this is not coding jobs. You don't need like, this is all low code, no code stuff. So it's like, anyone can do it. You just have to lean in and like open up the learning channels in your brain and figure it out. It's just work, right? It's just work. But I think that's a. Let me make one last point. And I think that the downside scenario, I think that there is a real possibility that whoever does it first is all of a sudden able to decrease their cost structure materially and offer lower pricing or better quality product, better service product at a better rate, and that the private sector is not going to create an application of this technology because your business systems and processes are so unique that they can bolt an AI onto an existing software. But if you're using 4 different softwares, they're not going to bolt on something that talks to this and this and this and this and does the data mapping for you, because you designed the data mapping, like you designed your own systems and processes. There's uniqueness to your business. So there's not going to be an obvious bolt-on that actually truly makes your business as efficient as it should be. And so so bolting it on is not actually a real thing that's going to happen. And like there's not going to be a private market solution that you can just bolt on. You're going to have to do the heavy lifting of getting your data in a structured format such that you can apply this technology, and then you have to apply the technology the way that you built your machine. And if you're waiting for the silver bullet to come,
sure,
we're just going to run past you. I'm just going to take your market share. While you're waiting for the private sector to do that, it'll happen too fast. I'll just eat your lunch while you're sitting there waiting. And I think that that's a real possibility too.
So where are you more excited about AI right now, from the property side, or from the lending side?
Both. Yeah. We have more people on the lending side right now, so that's my priority, because just purely from a math perspective, it makes more sense for us to start there. But all this stuff that I'm learning, I'm absolutely mentally being like, oh, I can apply this to property management here. I can apply this to construction there. So I'm building out a roadmap in my head for those other companies as we learn about the tools on the app and applying them to the lending company.
How much do you think the implementation, the early adoption, like I always think that like Amazon is Amazon, not because they deliver, low cost products. It's because of the customer experience, right? Like I can open up my phone and in 3 hours, I can have it sitting on my doorstep. And Bezos makes no bones about like, that's the whole mission, right? Like, let's make it as easy as we can, the most elegant customer experience. How much do you feel like the implementation of AI is going to change the customer experience from a lending standpoint?
Yeah, tremendously. I think that there are obvious gains there, and it doesn't physically take a month to close a loan, right? Like it's not as if there's 160 hours of work that need to be done. Right. It's nowhere close to that, right? And that was even if you had one person doing it, and you actually have like 5, right?
Right.
So like all of the work that's being done is being done. It's the handoffs, and it's the 2 steps forward, 1 step back, pivot over here, 2 steps forward, 1 step back, pivot back over there, that like end up resulting in those longer timeframes. But the whole thing's a big decision tree. Like it's all a mappable process. And so there's a lot. It's big. It's very, very big. Oh, dude, I saw this morning. Optimal Blue, which is an ICE Black Knight owned company. It's their resi consumer software. It's a resi consumer software. They've built a lot of AI tools into Optimal Blue. And so large resi consumer mortgage origination companies now have access to a lot of cool tools. So that's that idea of, hey, the software guys are gonna just build a bot into, build automations and build natural language reporting into my software. And so I don't need to do it. And that's true. I think absolutely that's going to happen. Optimal Blue just came out with it. They're humongous. Like they're like one of the biggest software companies in the country. And so, yeah, like we're already seeing it there. Right. But if you're not on Optimal Blue, so hey, if you're on Optimal Blue, cool, get in there and start learning playing with the cool new tools. If you're not on Optimal Blue though, everybody else is now like just, they made themselves much more competitive by having this feature set in there. But everybody who's not on Optimal Blue does not have that. And Optimal Blue doesn't do everything, right? So those are cool tools within the context of that software, but still you have to have set up your business around the structure of the software, which inherently has some limitations, just has definitional limitations to whatever the software's capabilities and processes are. But everyone who's not in Optimal Blue, not in resi consumer mortgage, like there's no business purpose lending version of Optimal Blue. Like Mortgage Office and Liquid Logics, and there's half a dozen like companies that are trying to compete for that space, but nobody has emerged as like the best in class product. So like, so that doesn't exist in the private lending space right now.
So we've talked to several investors here on the show about Salesforce as a CRM. We use Salesforce here, and I think the company has made a tremendous investment into it. What do you know about what Salesforce is doing from an AI standpoint, and how that might help some of our listeners as well as our company over the next 6 months to a year?
Yeah, just to be clear, from like most listeners, Salesforce is total overkill for your business.
Yeah, we get that.
I mean, if you're doing less than 15 million a month of hard money, don't bother. Like, it's not worth it.
I always
Just
say that
stay on Excel. Excel's fine. Like,
I always say that Salesforce is like the Photoshop of CRMs. It's got a million features, but you only use like 5, but you're still paying the same amount for it. So, but I think what they're doing from an AI standpoint is exciting, and even if people aren't using it, other companies like it will adopt some of these features. So maybe you can speak to that, what you're seeing.
Yeah. What's cool about Salesforce is that it's a structured database where you can do lots and lots and lots of stuff. The problem is you can customize it any way that you want to customize it. The problem is you have to customize it using it helps to know their coding language, and because it's so complicated, there's literally like full certification programs to be a Salesforce administrator. So there is a steep learning curve associated with it. There are other options like Zoho. that are much more user friendly and allow you to link stuff together in very cool ways that are, if you don't need big scale, then they're frankly just better solutions. We made the investment because we wanted to scale the lending business, and so it's been an annual investment. It's a significant annual investment and steep learning curve, and because there's a learning curve, you got some power users, but not every manager is a power user, and so every manager can't go in and make the revisions that they want in 5 seconds, like you can do in Google Sheets and Zoho and lots of other options, Zapier. So there's like big downsides to it, but the upsides to it are that you can build a $1 billion company on it, and it doesn't break between 100 million and $1 billion. Like nothing will break, nothing will change. Whereas the other ones they will break when you get to that scale. And so anyway, that's the reason we made a very long-term investment in that software, in that platform. I think that Salesforce has come out with Agent Force, which you've seen the Matthew McConaughey commercials on the Super Bowl.
Spent a lot of money on it.
Yep. $8 million a pop, I heard. $8 million. Yeah. And for 30 seconds. 30 seconds is $8 million.
I didn't see any Dominion commercials during the Super Bowl.
No, not yet. Not yet. Maybe a We Buy Houses, slide of We Buy Houses in there. Anyway, so they've come out with Agent Force, and they think it's their answer to Microsoft's Copilot, which is kind of gets the crap kicked out of it because it's not that cool. But even the Agent Force stuff is like pretty early innings still. Like they're advocating. If you listen to Mark Benioff talk, he's advocating this idea of digital labor. That's the new buzzword, digital labor.
You can have an unlimited labor force.
Yeah, exactly. Which is like that, which I kind of buy into. But it's not unlimited labor force because there are still things that are fundamentally human.
Of course.
I really don't see the sales process being automated like this. Like the human to human interaction there will be certain people who just want to go on a portal and upload their information and never want to talk to a human. Sure. And that stuff, it's important that we build that functionality, right? That we have that functionality. But I don't think that it's going to displace all things in business. The human to human interaction is like, I think something fundamental to people doing business together. So anyway, but the idea of digital labor is really interesting because you can train it one time and it doesn't get sick and it doesn't forget, and it's really smart.
Only gets better over time in terms of its intellect.
Yeah, exactly. And what's really exciting about it is that, and if you've got capital, or if you've got ops and capital to be able to put behind those resources, you can instantly have 10 of them, or 100 or 1,000 or 10,000. So like, there's no like, hey, we're starting up our hiring process and we're going to hire a bunch of people this year for this role. Like we need 30 of this role. You just create 30 of them, or have the one doing the work of 30, and so they're paying their Salesforce is trying to make up for the loss of seat licenses, which is how they currently charge. And this is a thing across all software, all SaaS companies, all software as a service companies. They're losing seat revenue, or they'd lost seat revenue. And Salesforce is trying to replace it with charging by the drink for what the agentic AI, what Agent Force is doing. So like how many charging you by the conversation, for example, for the chatbot. And they've priced it at a place where it's like, yeah, that's definitely cheaper than me having a human have that conversation. So if the if the chatbot can, using chatbot's like the most basic example, right? Like if the chatbot can access my entire library of data and I can tune its personality, and so it does just as good of a job as the human or the Filipino VA that I would otherwise have behind that chatbot interacting with my customers, and I can pay less for that conversation than I would with either of those alternatives, why wouldn't I? It's a better customer experience and it's cheaper for the owner. Like, duh. So, and it's infinitely scalable. But like that, the idea of digital labor is Salesforce big push right now, and the fundamental idea behind agentic AI. And I think we'll be seeing it in production, deployed in our economy. We will be interacting with these things, or they will be doing work, this year and definitely next year and the year after that.
And the reason I brought it up was full well knowing that most of our listeners probably don't use Salesforce, is because I think that type of functionality will be coming to most platforms pretty quickly, so that if you have some member of your staff who's doing highly redundant work, repetitive, I think that functionality is going to be happening very quickly amongst most platforms.
Mm-hmm.
Agentic AI will be something that everyone, I think, will be using within the next 6 months to a year and a half.
I think so. Yeah, I think so. 100%. I don't think we're going to have a choice in the matter.
No, I don't either. A couple other things I wanted to talk about, Jack, and we'll wrap it up here. State of DSCR. I know that we're heading out to Vegas. I'll be at what's the conference I'm going to, Jack? The National Home Builder Conference?
Yeah, the National Association of Home Builders, their International Business Show, IBS conference for National Association of Home Builders. Yeah.
I think that starts on February 25th. You mentioned that there'll probably be about 10,000 attendees, maybe 5 to 10,000.
Dude, it's a huge show. Some crazy number. I should look that up, actually. But like, they take over the entire Las Vegas Convention Center, which is a statement. Like, that thing is humongous.
It's massive.
Four different show halls that are each the biggest show hall I've ever been in. Like, you walk into one show hall and it takes you 6 or 7 actual minutes to get to the other side. Like, it is over a quarter mile long. Like, they're really huge, and they're all full of vendors. So there's lots of builders there, lots of trade. It's a ton of trade companies. But as a result, there's lots of builders.
What I'm most excited about is just talk with guys that are out there building and see what their sentiment is. And are they full steam ahead? Do they feel like it's going to be kind of a sideways slog this year? That's the discussions I'm really excited about. And when I go out there and meet a whole bunch of new builders and investors. But you're actually attending another show. And so, yeah, can you speak about that and sort of lump in the sort of state of DSCR?
Yeah, sure. So, yeah, back to back for us. The Builder Show is in the middle of the week, and the beginning of the week is the Structured Finance Association conference, which is basically thousands of guys in blue suits from New York, right, descend upon Las Vegas and talk about the securitization market. And I mean, they're doing mortgage securitizations, but they're also doing car loan securitizations and student debt securitizations. Any esoteric asset class that you can turn into a cash flow, Wall Street securitizes it. And so all the investment bankers and bond buyers and lawyers all come out to the Structured Finance Association conference and get together. And there's a melee of meetings. You'll go into the meeting areas, and it's like Wells Fargo's got a huge room, and they've just got like these curtains, like these curtain on structure with tables in them, and there's like 40 meeting rooms in Wells Fargo.
Like the emergency room at your local hospital. It's just like 2 curtains and a bed. Like, this is 2 curtains, like a table and 2 chairs for you to sit down and talk with some investment banker.
Yeah, it's an army hospital.
Oh, nice.
And there's just a bunch of blue suits running around having meetings and like waiting for the next person to come in, and desks where the people check you in and then send you back to curtain room number 17, and you have your 30-minute meeting and go to the next one. So it's quite an experience, and all the big banks are there and have those meeting areas. And so
what do you hope of it?
Yeah. We're going there because we're going to do another RTL securitization to do fix and flip loans, to try to get our cost of capital down as low as possible, to do more fix and flip loans. And And then we like the idea of doing a DSCR securitization as well, and actually keeping the DSCR loans that we're originating. So that's on the roadmap for us. But we're going to be doing an RTL securitization like in the next month. So that's like the primary motivation is to go out and meet with a bunch of bond buyers, do a little road show basically, and sell ourselves as a safe place to buy bonds from.
I'm sure I can't think of anything that doesn't sound less fun, frankly. But I'm sure you and Fred will get a lot out of it.
Yeah, no, it's fun. It's fun.
Give me your hot take on the appetite for Wall Street and the large insurance companies for DSCR in 2025. Are we going to have the same bucket of capital that we had in 2024, or do you think it's growing, or do you think it's diminishing?
It's definitely growing.
Really?
Yeah, it's definitely growing, but no one has, but you don't have the front runner that you had in years past where like one program is clearly better than everybody else. Now everyone's more tightly grouped together, but there's more companies that are more tightly grouped together that want to buy these DSCR loans. And so I think that it really favors, we never expected that one bond buyer or one loan buyer would, like, why would that be the natural progression of things? Like
one buyer would buy like up 95% of the loans, right?
Yeah. Which has been like the case. Like,
sure,
80% of production has gone to like Blackstone basically in the past, like for the past several years. They've kind of stepped back a bit and the pricing is more in line with everybody else. But that's kind of like where you would expect it to be, right? Is the natural is competition. And so we're really happy. I'm really happy about the strategic decision that we made to not affiliate with a particular loan purchaser or marry ourselves to a particular program, because with that competition, depending on your particular situation as a borrower, one of 15 programs is going to be the best one for you. And if you're not working with an originator that is working with all of the loan purchasers, well, you'll just get shoved into, like the corner of the box that you're in, you'll get shoved into somebody's some other program's subpar, suboptimal pricing. And so like being, having access to all the programs, I think is more important now than it was before, frankly, because of this more competitive environment.
So do you feel like that we'll see guidelines tightening, or do you feel like it'll just stay the same, or do you think guidelines will broaden over the next year? So I guess like break that down to sort of the listener level, the investor level. Are we going to have to check more boxes to get these loans done, the same amount of boxes, or less boxes to get them to fit into the note buyer's guidelines? Which is for the listeners, Jack, if, for those who, most of our listeners, I would think, have done DSCR loans. So you should know that it's not always a walk in the park to check all the boxes for a loan, right? If I've got a 6 unit in South Dakota, it's not always going to be an easy loan to do versus the single family in Baltimore, right? So what's your take on that?
Yeah,
especially with the newer note buyers that are coming into the market.
Yeah, I think that we're seeing specialists kind of emerge there. So it'll be a function of, hey, do you want to jump through these hoops? It's worth a quarter point to you if you jump through these hoops. We'll be able to very easily tell you what the hoops cost, right? And you can make a decision as to whether you want to jump through that bullshit or not. And we'll go either way, right? Like we're a conduit, right? We're like a low cost conduit. That's our approach here, is to be a low cost conduit. We're not going to change the loan purchasers' decisions on what their credit guys think the box should look like. And there's 15 different opinions of what the box should look like, right? There's not even conformity within the market with respect to what a good DSCR loan exactly looks like. And frankly, if we have this more stressed environment on a going forward basis, we'll see upticks in delinquency in certain places that will lead to changes in guidelines. There's an active feedback loop there between the loan purchaser, who also acts as asset manager and who's getting delinquency reports, and then seeing like, hey, I'm seeing a spike of delinquency in Southwest Florida, like for DSCRs below 1.1. Like we need to change our matrix to like stop that shit. So like I think that as more time goes on and we get more, and frankly the loan purchasers get more data on the nature of the stuff that they bought, their opinions on like how this stuff performs is going to change, and we'll I think we're going to see a constant evolution of guidelines and matrices again. So it's really important to have a full field perspective of all the available options, because one person's opinion may change based off of that delinquency data, but another portfolio may not have had that stuff in there. And so you won't see a guideline change with that other program. And all of a sudden they become the front runner for because somebody else backed away. So I think it's going to be a constant, like, guys, stepping forward and stepping back and stepping forward and stepping back in different parts of the box, so to speak.
But you do feel that over the next 12 months, we'll see a new crop of note buyers for
They're already in. Yeah. I think we've onboarded 4 in the past month, 4 new ones that are very competitive, that are going to win business.
Wow.
So yeah, no, I think it's a more liquid market in 2025.
That's great. That's great news for anybody who's out there, refining rentals or purchasing rentals.
If we could just get the 5-year to cooperate, it would be really great.
5 years been on a bit of a roller coaster.
And then we had the inflation data come out yesterday, and the 5-year jumped up 20 basis points. Yesterday being February 12th. So like, that sucks. So if we could just get that 5-year to cooperate, that would be awesome. So we'll see.
Yeah. But still doing those loans every single day of the week, Jack. And so, obviously people are out there finding deals that are, providing enough cash flow, even with the rates where they are today. Anything else you want to touch on?
No, man, we covered a lot of topics today.
We did. I didn't think we were going to speak for an hour.
That was good.
Well, I appreciate your time as always. Folks, that was our take on sort of where all things on Jack's mind today. Really appreciate everyone listening. Always love your comments. You can feel free to reach out to me on LinkedIn, Craig Fuhr. Jack is also on LinkedIn. You can leave comments on YouTube or wherever else you see us, Instagram. But we appreciate everyone listening. That's Real Investor Radio for today. We'll see you on the next one.